Good morning, everyone. What a year it has been in markets. I mean, if you think through the environment in which we've operating, firstly on the global side, it feels like the market has navigated this massive wall of worry. And at the moment, when we look at global equity markets, we think they're on a knife edge. We're seeing on a daily basis the market move between fear and greed. And we believe it's important for investors to stay focused on fundamentals. From our perspective, we're still finding very attractive opportunities in the global equity markets in our portfolio, but I'll unpack more of that a little bit later. Focusing then on South Africa, we've seen it's been quite a volatile period where still economic growth is nowhere to be found. But the negative sentiment has definitely impacted on market behavior, and we are finding very select opportunities within the local market. Shifting onto the portfolio, we think it's very important that investors to continue to have balance in their portfolio. It's that key of not avoiding risk, but managing risk as we navigate these very volatile markets. The question I often get from clients is, Duane, how are you and the team able to navigate these markets in a very narrow market environment? And you will know that if you think on the global side, the whole environment has been driven by a very narrow performance of the stocks affectionately known as the Magnificent Seven, the likes of Microsoft and others that have really been driving the markets. And we look at the cumulative returns that we've seen since the lows of 2022, it's been a very attractive market for investors to have exposure to those growth assets. But when you look beneath the hood, you will see when you focus on that equally weighted MSCI All Country World Index, that not everyone is winning in these markets. And that's what's giving us the opportunity as bottom-up stock pickers to find some of those more attractive valuations in a very narrow market, with the markets purely focused on that Magnificent Seven. Maybe some caution, while we are still quite balanced in terms of the upside potential in the portfolios that we manage for you, we caution investors that multiples or valuations are quite stretched at the moment. And I'm sharing with you two slides that hopefully highlights where we are from a valuation perspective. The first chart, when I show you the MSCI All Country World Index price earnings ratio relative to history, you will see that 19.3 times next year's earnings is very high relative to history, pretty much in line with where it was at the peak in 2021, but more importantly, more than one standard deviation away from the average. You then look at the next chart, which shows you the concentration that we're seeing in the market of the top 10 shares. And whether you look at the S&P 500, which is the top chart, showing you that the top 10 shares account for 40% of the index, or the MSCI All Country World Index, where you see the top 10 shares account for 26% of the market, the message is quite simple. You're finding that the largest stocks are really dominating the returns. And so when you think about opportunities, we think the divergence in markets are quite key for investors to understand. Now shifting on to how we think about the AI trade, and probably the poster child of AI is NVIDIA, that we don't own in the portfolio. And the biggest reason why we don't own it in the portfolio is our large concern around the sustainability of NVIDIA's earnings. What I'm showing you in this chart is the return on invested capital, a metric that we as quality investors focus on. And in simple terms, you will see NVIDIA, so return on invested capital is 140%. So for every $1 that NVIDIA invests in their own business, they're generating 140% return. We just see that as unsustainable. You will see the long-term history for some of the other quality companies, some of them that we do own in the portfolio, is more reasonable and sustainable in our view. Then shifting on to the important message I wanted to land today is just with all the hype around, yes, the market has run hard, yes, index valuations look expensive, we think when we focus specifically on the Global Franchise Fund or our high-quality global equities, we think we are finding quite attractive valuations. And I know this is a busy slide, but in simple terms, if you look at maybe just the first part of the chart, the since inception of the Global Franchise Fund returns versus the MSCI All Country World Index, you will see that the dominant driver of those returns for the Global Franchise Fund has been earnings growth that has been faster than the market, 6.7 versus 3.6. That is the trend that we would expect to continue longer term, but what you would see from the next two columns, that has not been the case over the last 3 years or the last 12 months, where despite our high-quality global earnings in global franchise growing faster than the market, we have underperformed the market. And the reason for that is you've seen an expansion in multiples. So you will see that valuation bar is symbolic of companies re-rating, becoming more expensive because the market is anticipating that their earnings will improve going forward. We think this is the key risk for investors to understand. And ultimately, we think the risk for overall market levels is those earnings levels disappoint, and at which point you will see pressure on the index, whereas we're quite confident that our companies will continue to deliver the earnings that we think, given their idiosyncratic drivers, and importantly, we think valuations for our stocks is quite cheap relative to the history of the portfolio. So now let's shift to South Africa. I mean, we all know it's an environment where there's no growth to be found, but oftentimes you realize that the stock market is not the economy, and despite the negativity around the economic growth, there's been quite strong returns for local investors across growth assets, whether it be global equities, local equities, property, even bonds coming to the portfolio. But it's important to not just focus on the rearview mirror. What is the outlook going forward? And we think ultimately there are select opportunities in the local market, and it's important for investors to not extrapolate the very strong returns they've received from the local market over the last year. What's been driving the returns? And I think for me, this as bottom-up stock pickers tells a very strong story. We know year to date, the all-share index is up almost 32%. Very strong year for investors. But what is missed is the nuance of what's been driving that return. If you look at the top contributors to the index performance over the last year, has all been the golds and the platinum shares. You will see some of them up more than 200%. That is not symbolic of what's happened in the market. And so while we find the returns in the market has been driven by the golds and the plats, to some extent, like a Naspers and a Prosus and British American Tobacco, you'll find the average SA Inc. company that depends on the macroeconomic environment is actually down year to date. The likes of the retailers, the likes of Bidvest, actually down relative to last year. And you will say, when you look at that, ultimately that is some opportunities that's starting to creep into the market where investors are really giving up on SA Inc. We all know the challenge. This is a very busy slide. The only thing I want you to focus on is it really talks to valuations. And the blue line, our price earnings multiple, shows that it's sort of low relative to history. The big one I want you to focus on is the yellow line, which speaks to economic growth. And economic growth has been nowhere to be found for the last decade. And really, for the market to get excited, we need to see economic growth go north of 2%. And that is unlikely, in our view, over the next 3 years. However, we are not the only ones that are skeptical on the outlook for economic growth in South Africa. This slide shows you what foreigners have been doing since 2016. And you will see the only time the line is above zero is in 2018 with Ramaphoria. Outside of the Ramaphoria environment, you've seen foreigners have continued to be net sellers of our market. They paused post the announcement of the Government of National Unity, but as they've looked and seen that nothing has fundamentally changed, they continue to be net sellers of our markets. We actually take this as a positive because while sentiment has resulted in cheaper valuations, we think you only need to see a little bit of improvement in economic growth and valuations could surprise to the upside. So how are we finding balance in the portfolio? These show our bottom-up return expectations over the next 5 years for the different elements of our portfolio. An important disclaimer, this is not the market. This is for underlying securities we hold in the portfolio. And you will see relative to the orange line, which is the CPI plus 6 target, you will see that there's very attractive returns we find in the select SA-listed local equities that we own in the portfolio, the likes of a Capitec, the likes of a ShopRite, a JSE, a Santam. If you then think of some of the dual-listeds, the SA-listed global equities, like Prosus, like Mondi, like British American Tobacco, like Bidcorp, healthy double-digit returns over the next 5 years. Given the strong rally in global equities, we still find very attractive value, but be mindful that we are cautious, obviously, in that downside conservative scenario, but still relative to the target, and given the diversification benefits, we think they need to be a healthy weighting in the portfolio. Shifting on to SA bonds, we remain constructive with a preference for nominal bonds as compared to inflation-linked bonds, but we do think both need to be held in the portfolio. And then maybe just lastly, I will say, when we think of the other asset classes, we think cash is less attractive than it has been for some time, and then we don't find attractive valuation in global bonds. And then lastly, I would say, when the outlook for SA property, we think the range of outcomes is still quite wide, and we don't have exposure in the portfolio. This slide maybe just gives you a sense of where our asset allocation is for the Opportunity Fund. As a reminder, this fund can hold up to 75% in equities. Currently, it's sitting at 66%, with a healthy weighting in global equities, but also some of those SA-listed global equities I referenced earlier, as well as some of those SA Inc. stocks where we find valuations quite attractive, even taking into account an environment where we are quite conservative on economic growth. You will see 15% of the portfolio in SA bonds. We've actually increased that exposure post-quarter end, now currently sitting at probably 16%, as we think bonds remain a great diversifier to the offshore holdings that we own in the portfolio with very attractive real yields. This just gives you a flavor of some of the type of equities we own in the portfolio. You will see that balance that looks very different to the index. The cornerstone of the portfolio is the types of stocks that we think can deliver low double-digit free cash flow growth over the next 5 years, the likes of a Visa, Bidcorp, Microsoft, Richemont, and supplemented by some very fast-growing businesses, the likes of ASML, TSMC, and Capitec. But importantly, how do we protect that downside? Owning a collection of defensive businesses that we think have got very strong balance sheets, bulletproof outlooks in terms of earnings, the likes of a British American Tobacco, a Beiersdorf that owns the Nivea brand, as well as Santam. So in an environment with increased volatility, you will see the advantage of some of that defense in the portfolio to protect the downside. So then just lastly, if I were to summarize our views, that yes, we've had an incredibly volatile year, and yes, markets have run hard, but we are still finding great opportunities to invest your capital. We find global equities offering the best opportunity for growth, businesses that look very different from the index, that we think are confident can grow double digits over the next 5 years, unlinked to the macroeconomic outlook. From a South African perspective, we think companies that are select in terms of those dual listeds and then some of those higher quality SA Inc. names where the valuations are more attractive because of that negative sentiment that is fed into the market. And then lastly, having balance in the portfolio by owning those SA government bonds with real yields that are of the highest of any other emerging markets. So with that, I want to thank you for your time and wish you best of luck for the rest of the year. Happy investing, and then over to you, Sine.
Duane, thanks so much for that insightful presentation. I thought it was a great summary of your views and your outlook. But I've picked up on a few things that I would like to just pick your brain on a little bit more. I want to start with your growth exposure. So 91 opportunities sitting at, let's call it 90% of your risk budget, which is quite high. Yet in the market, if we look at what clients are doing with their assets, the income space is still where clients are sitting. So multi-asset high equity is starting to return from a net inflow perspective, but clients are still conservative. Yeah. What do you think is the driver between the mismatch? How do you as asset manager, have the, let's call it guts to take on all the growth exposure, but clients aren't there yet?
Excellent question. It's something that we've been grappling with because I think since the days of COVID, I think the market has dealt with so much volatility, and ultimately investors have been able to sleep quite well at night, hiding in income assets, without having to take a lot of risk for conservative investors. But we do think that is changing, and what's ultimately changing that is the outlook for rates. And so we're finding interest rates both globally and in South Africa will continue to come down. And ultimately, those investors that are now focused on the rearview mirror is going to miss out the fact that actually cash rates are coming down. Our bonds have rallied quite strongly. And so if you're looking for double-digit, low double-digit type of returns, unfortunately, you're not going to find that anymore hiding in cash and bonds. And having some element of growth assets we think is key. The tricky part in terms of what investors are going to have to navigate is that knife edge of being, but like growth assets have actually rallied quite hard. And so how do you add risk to your portfolio now when markets have been buoyant in both the local side and in South African market? And that's where I come with the nuance that because the market has been so narrow, we are still able to find great opportunities outside of the Magnificent Seven offshore and outside of golds and plats in the local market.
You made the comment in your presentation that you don't think cash is attractive, obviously related to the fact that rates have come down. And what I often tell advisors when we do presentations and feedbacks is to read the manager's exposure in terms of how much of the risk budget they are using as whether or not they're finding opportunities. So is it fair to say that advisors can read your asset allocation as, yes, markets have run high already, but there's still opportunity left to invest in?
No, definitely. We are obviously quite constructive around our portfolio. So that's its whole schizophrenic where if you think of the stuff that we own in our portfolio, the growth assets, we're quite excited because relative to history, the valuations look quite attractive. And the market has almost given up on those type of holdings that are still great businesses, but because the market has been chasing a very narrow part of the market, they've used those as the funding source. So in our view, when we think those companies will continue to deliver the earnings growth we expect, their starting valuations are quite attractive, and so therefore can give double-digit returns in our view over the next 5 years. We think that's very attractive coming off that base.
No, definitely. And then similar question, same or different, is your offshore exposure. Definitely another frequently asked question we so often get. How much is the right amount of offshore exposure? And I think, you alluded to the growth being low, and advisors or clients often look at low growth in South Africa, the rand being strong, being removed from the grey list feels positive because, it's easier now to take money offshore, positive for an offshore exposure. Is it as simple as those things are all pro-offshore, take all your money offshore? Or how do you think about, what's the right way to think about how much offshore to have as a South African investor?
Unfortunately, it's not a simple answer, and people always look for a single point estimate. But the way that we as a portfolio management team think about it is normally threefold. Right? So when you think about what the right number is, it all depends on what your return outlooks are going forward off this base. Are you finding attractive offshore assets that gives you strong growth and returns in hard currency? That's sort of like the first question you've got to have to answer. The second question you've got to answer is, does it add to your portfolio diversification, and in some cases give you access to parts of the market you can't access in the local market? And the example I would use there is technology, where you don't really get semiconductors in the SA market. You have to get that exposure offshore. And then the third part you've got to answer is, what's your view on the rand? And ultimately that does change over time. And if we think of where we currently positioned we think the rand is about fair. So when we put all of that together, we think you need to have a healthy weighting to offshore. We've got a 45% offshore allowance in line with regulations. At the moment, we're sitting physical exposure about 42%, but with currency forwards, we've hedged some of that. So effectively sitting at 38 says that in simple terms, it means that we kind of haven't used our full offshore allowance because we are finding still some good opportunities in the local market, but still a healthy weighting offshore.
I'm going to squeeze in one more question before we end off, and that is gold in the local market, so gold and platinum. You again mentioned it in your portfolio, in your presentation on your portfolio, that it's run very hard. Some stocks are up to 100%, and it's now quite a big part of the index. In our view, or something we hear a lot, is that gold companies traditionally aren't high quality companies. Eventually, their costs catch up with the spot price of gold. There's a bad track record of capital allocation decision. So in my view, not necessarily the company you want to have make up a 20% weight in your portfolio. But now in the index, it's around 25, 26%, which creates for me a bit of a risk that your active managers who don't believe in gold companies to that extent will underperform the index. I mean, how do you think about it? How do you look at what does the benchmark have? How much do we go underweight? Must we follow the benchmark, in particular with gold and platinum?
Now specifically for our team, we run an app like the Opportunity Fund, the 91 Opportunity Fund is an absolute return fund. So we obviously benchmark agnostic. And it's amazing how people think about it, because you probably won't know, I started my career as a gold analyst. And you'll know that the history of gold companies actually being poor allocators of capital. They don't really generate free cash flow over time, and they are highly cyclical. And it's very difficult to forecast the earnings over time because it's so dependent upon the gold price. And over time, the management teams have tended to be poor allocators of capital. So when we think of it with our quality lens, they don't meet that hurdle. And the challenge is, like you said, golds and plats combined is about 26% of the index. Gold's on its own is about 16% of the index. But like I said, we benchmark agnostic. So we've got zero.
Sure.
So why do we have zero? And it comes back to, we think firstly the gold prices run quite hard and probably see more downside than upside from here. So that's the metal itself. And then from the equity perspective, we think they are the most profitable on spot than they have been for the history. And so we don't think that is sustainable. And when we think of how hard they've run, how big, they're probably at their max weightings they've been in the index, we think any correction in the gold price will see a significant downside to those gold equities. So I think owning gold equities at this point of the cycle, we think is just too risky and comes with significant downside risk. And so we've got zero exposure for our clients.
Okay, wow, interesting. And thank you so much for your time. I think that's all we have time for, and thank you to our listeners as well for still being dialed in. We'll be back very shortly with the final stint of today's webinar.